Welcome to the deep dive. Today we're really digging into something critical. A forensic autopsy of Lululemon Athletica, ticker LULU, of course.
Right. And for years, this was a company that, it felt like it was totally immune to gravity. It just defied all the normal rules of retail.
It really did. But that whole story, that narrative of exceptionalism, it just came to a crashing halt.
A violent end, really. December 11th, 2025, the Q3 fiscal 2025 results dropped. And, well, this is so much more than just a bad quarter. This signals a structural fracture in the company.
Exactly. And when those results came out, the headlines were, let's be honest, they were a bit misleading.
Oh, for sure. A classic low-quality beat. They optically managed to beat the lowered EPS expectations.
But our job today is to get past that surface-level stuff. We are going to dissect the underlying decay, the operational rot that really confirms the whole Lululemon business model.
As we knew it?
As we knew it, is fundamentally broken.
Yeah, this wasn't just a soft patch. This wasn't a cyclical inventory thing that, fixes itself in a few months. The structure itself failed. For almost 2 decades, Lululemon was basically in God mode.
God mode, I like that.
It was, and it rested on these 3 pillars. First, scarcity-based merchandising, creating that FOMO. Second, vertical integration that gave them these incredible, almost software-like gross margins.
On a t-shirt.
On leggings and t-shirts. And third, this cult-like brand loyalty that just shielded them from any price competition.
And this Q3 report, it's the final nail in the coffin for that era. It tells you those moats, they've all dried up.
So, okay, let's unpack this. Some of the numbers are just astonishing.
We have to start with the most catastrophic one. A negative 5% comparable sales decline in the Americas.
Minus 5%.
In their core market. It means their most loyal customers actively rejected the brand. That's a stunning number.
And that rejection, it had an immediate and, well, a painful financial consequence, right? Oh, absolutely. The unprecedented 290 basis point collapse in gross margins, it drove their profitability down to 55.6%. And this is the key thing for you to understand. This isn't temporary.
Right.
Our sources show this is driven by permanent shifts. They've lost their pricing power, and they're getting hit with new trade tariffs.
And then, to top it all off, the leadership decapitation. The forced resignation of CEO Calvin McDonald.
The board basically telegraphed it. By timing his exit with this disastrous report, they were admitting the failure was terminal under that regime. And that, right there, is where we're going to start our deep dive.
So when we talk about Lululemon's history, we often use these fortress metaphors. It was protected by those 3 pillars you mentioned: scarcity, vertical integration, and brand loyalty.
A fortress is a good way to put it.
For anyone listening who hasn't followed LULU day to day, can you just remind us why that scarcity model was so incredibly powerful and, why it was the first pillar to just crumble?
Well, the scarcity model wasn't just, clever merchandising. It was basically behavioral economics applied to leggings. Seriously. The strategy was to intentionally produce, say, 80% of what they thought the demand would be. And this did 2 crucial things. First, customers knew if they saw their size in that hot new color, they had to buy it right then.
Or it's gone forever. The FOMO, the fear of missing out.
Exactly. It just accelerated full price sales like nothing else.
And the second thing?
The second thing, and this is so critical, is that it meant Lululemon almost never had to discount its products. Markdowns are the cancer of retail margins.
They kill profitability.
They absolutely kill it. So by maintaining that scarcity, they maintained their premium price point. All of that flowed directly to the bottom line, supporting those, those phenomenal gross margins we all used to talk about.
But now our analysis shows they've just completely violated that rule. They compromised the quality you need to justify a $98 price tag.
They did. And the damage from violating that rule, it became visible right where it hurts the most.
In their primary market.
In their primary market. The company has completely inverted its greatest strength, North America, into its single biggest liability. The fortress wasn't just breached. The foundation in the Americas is actively crumbling inward, and it's dragging everything else down with it.
Okay, so let's drill down on that. The Americas contraction, a minus 5% comparable sales decline. That's a number we're used to seeing from, like, a dying department store.
Or Sears or a JCPenney. Yeah.
Right. Not from a leading global athleisure brand. So what does that minus 5% comp actually signal about the relationship Lululemon has with its core customer now?
It signals a profound rejection, a complete breakdown. See, comparable sales, they track the performance of stores that have been open for over a year, plus the online channel. So a decline means 2 things are happening. One, your existing loyal customers are buying fewer items. And two, all those brand new stores you opened are underperforming. And this is happening at a scale we haven't seen since the Sheerness scandal back in 2013.
See-through pants. I remember that.
Everyone remembers that. But the difference is, back then, the problem was contained. It was one product failure. Today, the problem is systemic. It indicates just a total loss of brand resonance.
And the immediate financial consequence of that is the margin erosion driver. That 290 basis point collapse from 58.5% down to 55.6%. I mean, in the retail world, that is a gut punch.
It's a knockout blow.
And you've emphasized this isn't because of temporary shipping costs or something. So if it's structural, what does that tell us about their long-term health?
The structural factors are what should really keep investors up at night, because they're effectively permanent fixtures of this new cost environment. We are looking at a permanent increase in their cost of goods sold.
Driven by those tariffs we'll get to.
Driven by tariffs, yes. And that's combined with a necessary decrease in their average selling price, because they have a discount now. So they are getting squeezed from the cost side and the revenue side at the same time.
Wow.
That premium pricing power, which was the entire engine of their profitability, is permanently impaired. The consumer just no longer accepts the justification for paying full price.
So fewer people are buying, and the ones who are buying at lower prices, they're making way less money on every single unit they sell. And this is where it gets really interesting, because that leads directly to the inventory issue. You call it the inventory time bomb.
Yes.
Inventory levels have just ballooned, up 11% year over year to almost $2 billion. Meanwhile, revenue only grew 7%.
That bearish divergence is the clearest leading indicator you can find of future profit impairment. Inventory growing that much faster than sales means that Lululemon has a massive amount of product just sitting in warehouses and in the back rooms of stores that is not moving.
It's just sitting there.
It's just sitting there. And if North America is shrinking by 5% in comps, that 11% inventory growth is a colossal mismatch with what customers actually want to buy.
We used to think of Lululemon's management as these master operators of inventory, keeping everything lean on purpose. What does this glut tell you about the quality of what's piling up?
It tells us they have the wrong stuff. They have the wrong product mix. They accumulated what management themselves called predictable casual assortment. Predictable. Think of the soft lounge items, the basic colors, the stuff with really low barriers to entry that we've talked about. The consumer has already seen this. They didn't want to buy it at full price, and now it's just sitting there clogging up the entire liquidity pipeline.
And a glut of inventory means one single painful thing for the financial statements down the road.
Clearance. Precisely. That $2 billion backlog isn't just a number on a spreadsheet. It's a liability. It has to be converted into cash. And to move that much product, especially stale product, Lululemon will be forced to dramatically increase its markdown intensity all through fiscal 2026.
So that 290 basis point margin hit we just saw
is just the beginning. It's a leading indicator for even more margin compression next year. The scarcity model is definitively dead. The era of the retail glut has begun for them, and it's going to cost the company hundreds of millions in lost profit and require a really painful reset of what customers expect to pay.
So the fracture wasn't just financial, it was. It was existential. You can't talk about the Q3 collapse without immediately talking about the leadership chaos that came with it.
No, they're completely intertwined.
The announcement that the CEO, Calvin McDonald, would be leaving effective January 31st, 2026, it was phrased as him pursuing new opportunities.
The classic euphemism.
Right. But the forensic analysis here suggests, well, a corporate execution. A forced ouster timed perfectly to distract from these horrible Q3 results.
The timing is just too neat to be a coincidence. I mean, in corporate governance, when a CEO exits immediately after a disastrous earnings report, that is the ultimate signal of a complete loss of board confidence. McDonald was effectively sacrificed.
A sacrifice to show they were taking it seriously.
Exactly. The board was demonstrating they understood the severity of the crisis and were willing to take extreme measures to reset the brand's trajectory. His whole long-term strategy, the Power of Three plan, was clearly failing to deliver profitable growth.
So let's look at the red flags that really confirm this was a crisis, not some polite departure. The first one is the valuation capitulation. It sort of provides the context for why the board was so desperate.
Absolutely. When McDonald makes his exit, the Lululemon stock is trading at a PE multiple of, roughly 12 times earnings?
Which is the lowest it's been in a decade.
A decade. And on top of that, the stock had just plummeted a staggering 51% year-to-date. A company's valuation multiple is the market's long-term barometer of its faith in the leadership.
And their ability to allocate capital.
Precisely. So when the market multiple collapses from that 30 or 40 times range down to 12, that is a definitive vote of no confidence. The board had to act just to stop the bleeding and signal a reset before the company got permanently priced like a slow-growth legacy retailer.
And it wasn't just the guy at the top. The chain of command removal suggests the board had already figured out where the failure was coming from.
That's right. McDonald's departure was actually preceded just a few weeks earlier by the exit of Celeste Burgoyne.
The former president of the Americas.
Right. And just think about the messaging there. You systematically remove the top executive responsible for the Americas, the main revenue driver, and then you remove the CEO.
It's a clear signal.
It confirms the board views, that domestic sales contraction, that damning -5% comp decline, as a direct and frankly unforgivable failure of execution by that leadership team. It wasn't some random macro event they couldn't control.
Now we know the founder, Chip Wilson, is still an influential voice. He's external, but he holds about 8% of the company. Did his agitation play into this execution?
Oh, it certainly provided the political cover and the pressure they needed. Wilson is a known, very vocal critic. He has repeatedly lamented the brand's dilution.
He's been saying for years they're moving away from their technical roots.
Exactly. Criticizing the shift toward less differentiated streetwear and away from that core technical performance excellence that built the brand in the first place. His public complaints about stale product and quality issues, they likely galvanized the rest of the board.
So McDonald's exit was a strategic reset, but also
a necessary sacrificial offering. It was to placate that influential shareholder bloc and signal a return to the brand's high-performance roots.
Okay, so let's pivot to the attempted solution here, the succession plan. The board appoints Andre Maestrini as president and chief commercial officer. On the surface, bringing in a top international guy sounds promising.
It sounds like a logical move, but it immediately raises this huge red flag of what we call the succession trap.
The succession trap, what is that?
It's a dangerous mismatch between the skill set of the new leader and the immediate, urgent needs of the company. Maestrini's resume is spectacular, no doubt, but it's rooted entirely in expansion.
He's a growth guy.
He's a hyper-growth guy. He oversaw the incredible growth of their international segment, especially in China and EMEA, which delivered that robust plus 33% international revenue growth. He's an incredible growth architect.
But the U.S. business is hemorrhaging money and relevance. It needs radical surgery, not a new wing built on the house.
Exactly. Maestrini lacks a proven track record in the specific North American turnaround that's required. He needs to figure out why the product assortments are failing, reestablish pricing power in a market that's now used to discounts, and rebuild trust with a core customer that has already left.
So the analogy is?
The analogy is stark. The board hired an invader general, someone brilliant at conquering new, untouched territory, when what the patient desperately needed was a meticulous surgeon to stop the bleeding and repair a broken system at home. The strategies for greenfield expansion and mature market restructuring they're antithetical.
And this whole crisis was made worse by a leadership vacuum that had already been there for months.
Yes. The departure of the chief product officer, Sun Cho, back in May of 2024.
That created a big hole.
It left a gaping 9-month hole in the innovation pipeline. And the operational results we saw in late 2025 are the direct consequence of that. I mean, apparel lead times are long. You need 9 to 12 months to design, source, manufacture, and ship a major new product line.
So that chaos after she left.
It just compromised that crucial feedback loop between the merchants and the designers. And it ensured that when the critical holiday season arrived, they had no newness, no exciting technical innovation to fight back against the high-end competitors or the low-end dupes.
And the ultimate case study in that breakdown, which our sources really highlighted, was the breeze-through product launch.
That launch was, by all accounts, an operational disaster. It was rushed to market. It was supposed to be the next big thing, the franchise to pull demand away from the aging Align pant. But it failed catastrophically on its technical merit.
What went wrong?
Reports cited issues with fit, Quality complaints, mass returns. I mean, that is the ultimate humiliation for a technical apparel company. This wasn't just a sales miss, it fundamentally damaged the brand's reputation.
Because the premium price is only justified
by technical superiority. If you force a product to market that fails quality control, you compromise the price, and the entire high-margin structure just buckles.
All right, let's perform the core forensic autopsy on these Q3 2025 results. The headline numbers were $2.6 billion in revenue, which was up 7% year over year, and that $2.59 EPS beat of lowered expectations. Yeah. To a lot of people, this looked fine. A little slow, maybe, but not a disaster. Yet you call this a low-quality beat. What exactly is low-quality profit?
A low-quality beat is when the headline numbers are kind of massaged to look acceptable, but the true operational health, the engine that actually generates future cash flow, is deteriorating rapidly. It's the textbook definition of profitless growth.
And how do you spot that?
The key to spotting it is looking at the divergence metric, the gap between the revenue line and the operating income line.
Okay, walk us through that divergence slowly, because this is really where the deception lies.
Okay, so revenue grew 7%. That's the good news they want you to focus on. But now look at the engine. Operating income, it didn't grow. It shrank. It shrank by 11% year over year, falling to about $436 million.
Down 11%.
Down 11%, and that reported EPS of $2.59. That was actually down 10% from $2.87 in the same quarter last year.
Wait a minute. So if they increased sales by 7%, but their operating profit fell by 11%, that means they're putting in way more effort, selling slightly more stuff, probably through discounts or new stores.
And fundamentally making less money on every single transaction.
Wow.
Precisely. They are running faster just to fall backward on core profitability. The top-line revenue is being held up by the successful but much smaller international segment and new stores. But the underlying unit economics of the mature business are just severely impaired.
Because of the lost pricing power and rising costs.
Exactly. If the cost of generating revenue rises faster than the revenue itself, the business is fundamentally breaking down.
And the ultimate cause of this breakdown, we have to stress it again, is the Americas contraction. Americas revenue down 2% and comparable sales down 5%. Why is that specific metric even more concerning than the overall revenue number?
Because the Americas represents the pinnacle of Lululemon's profitability. This is their most established, highest margin customer base. These are the people who bought the Align pant religiously for years.
Right.
A 5% comparable sales decline is an accelerating problem. It signals a major loss of market share. And the fact that management commentary explicitly connected this contraction to higher markdowns, well, that's the fatal admission right there.
So they put the product on sale more than usual, and still the sales volume in their core market fell by 5%.
It's worse than just slow sales. It's a consumer rejection of the product proposition. The customer is signaling loud and clear, I will not buy this new stuff, even when you make it cheaper for me.
The market penetration in North America has not just stalled, it's gone backwards.
It is inverted, and the drag that places on the overall enterprise value is immense.
And yet that 7% overall growth means something is working incredibly well somewhere else. This leads to what you call the bifurcation of the business model.
That's right. The international segment is now the sole valuation engine. It's posting plus 33% revenue growth, plus 18% comparable sales, and it's all driven by this hypergrowth in China mainland.
So international is the only thing keeping LULU from being classified as a deeply distressed retailer.
That's it. China mainland, for example, was posting numbers like plus 39% in prior quarters. The strategic implication here is vital for you to grasp. Lululemon is no longer a domestic growth stock. It is morphing into a complex multinational.
It's basically Chinese growth stock.
Attached to a shrinking legacy U.S. retailer.
Yes. I get that the growth is a good thing, but why does this strategic shift introduce a massive risk that wasn't there when the growth was all happening at home? Can't the international expansion just replace the stalled U.S. growth?
Well, it fundamentally changes the required valuation multiple through what we call the geopolitical discount factor. Investors now have to underwrite massive inherent external risks. We're talking about potential geopolitical trade tensions, the risk of retaliatory tariffs, the volatility and slowdown risk of the Chinese economy itself, and, the potential for local consumer nationalism to just quickly shift preferences away from a Western brand.
So even if the China segment keeps growing at 30%, And investors shouldn't treat those earnings dollars the same way they treat safe domestic U.S. earnings dollars.
Absolutely not. Safe domestic earnings historically commanded that pristine 30 or 40 times PE multiple. Earnings that come from a region with high political and economic volatility, where the regulatory environment can change overnight, they demand a significant discount.
And the market sees that.
The market's aggressive multiple compression from 30 times down to 12 times is a direct reflection of this new, riskier identity. The market is basically saying, we see the growth in China, but we will not pay a premium for growth that we cannot guarantee the stability of.
Okay, let's focus now on that Q3 2025 gross margin. 55.6%, down 290 basis points. You maintain this is the core structural problem. What's the evidence that this damage is permanent and not just, a blip from some temporary logistics issue?
The evidence points to three distinct structural factors, and the largest of these is actually a change in the legal framework governing their cost base. We can fully bridge that 290 basis point collapse to these three permanent or at least very sustained pressures.
Okay, so detail the first factor for us, the de minimis shock. Now, for the listener, this sounds like some arcane financial term, but it was absolutely central to Lululemon's historical profitability. What is the de minimis exemption, and how did Lululemon use it?
This is so critical to understand. The de minimis exemption, it refers to Section 321 of the U.S. Trade Act. And historically, it allowed U.S. companies to ship individual packages valued under $800 directly from foreign countries, mostly Asia, to U.S. consumers, completely duty-free.
So they were bypassing standard U.S. apparel tariffs.
They were masterfully bypassing them. Lululemon, with its huge volume of direct-to-consumer e-commerce, was a master of this supply chain arbitrage.
And those tariffs are not small.
No. Standard U.S. apparel tariffs can range anywhere from 16 to 32%, depending on the garment. By shipping directly from their Asian distribution hubs, they avoided paying these duties, which kept their cost of goods sold artificially low and maximized those premium gross margins.
Until now.
When the U.S. government, specifically the Biden administration in 2024 and 2025, cracked down on this loophole, citing security and fairness concerns, that cost arbitrage just evaporated overnight.
So Lululemon suddenly had to start paying tariffs on a massive chunk of its e-commerce shipments that were previously duty-free. How big was that financial hit?
It was immense. Management cited this increase as about a $240 million annualized cost, with about $210 million of that directly impacting operating income. And this isn't a temporary cost. This is a permanent structural reset of their entire cost base.
To put that in context.
That $240 million hit is almost 60% of their entire Q3 operating income.
Wow. So if they wanted to get that 290 basis points back, they'd have to find $240 million in savings somewhere else, or charge customers $240 million more a year.
But given the America's contraction, raising prices is impossible. They are trapped.
Trapped between rising costs and falling demand.
Exactly. The closure of the de minimis loophole meant their cost of just acquiring the inventory rose permanently, forcing their margins down. This is why we say their earnings power is structurally impaired. They can't just go back to the way things were.
Okay, so that's the biggest piece. Factor 2 accounts for the rest of that margin decline, about 70 to 120 basis points. Markdown intensity.
And this is the direct consequence of that inventory glut we talked about. The remaining margin decline is attributed entirely to necessary higher markdowns on that accumulated, predictable, casual assortment.
The stuff nobody wanted at full price.
The stuff nobody wanted. This is the market reacting to their product void. They have too much basic, uninspired product that isn't selling, so they're forced to slash prices just to generate cash. And this markdown intensity is likely going to accelerate into the first half of 2026.
And then factor 3 is the slow burn that happens anytime sales shrink in a high fixed cost business. Fixed cost deleverage. Explain how shrinking sales in the Americas actually makes their existing stores more expensive to run.
Right. Think of a mature store in, say, Manhattan or Beverly Hills. That store has massive fixed costs. The rent is $200,000 a month. The utilities are fixed. The specialized labor is on contract.
Costs you have to pay no matter what.
No matter what. Historically, Lululemon's high sales volume meant those fixed costs were spread across hundreds of thousands of high-margin units. That's called leverage. The cost of the rent per unit sold was negligible.
But now,
with America's sales shrinking by 2% and comps down 5%, you're selling way fewer units through that same expensive fixed structure. So the fixed costs now deleverage.
the rent per legging sold goes way up.
It goes up dramatically. And this accelerates the margin damage, and it's particularly punitive because their U.S. store fleet is their most mature and most expensive asset base.
Let's look at that inventory time bomb again, but with a financial nuance this time. The divergence between unit growth and dollar growth. Inventory grew 11% to nearly $2 billion, but inventory unit growth was only 4%. That gap is huge.
And this is the double whammy that absolutely guarantees future margin compression. The inventory dollar growth, that 11%, represents the cost of the goods sitting on the balance sheet.
Okay.
Since that dollar growth so significantly outpaced the actual volume of items, the 4%, it means the cost of the accumulated inventory is far higher than normal.
And why would the cost be higher?
Primarily due to the initial impacts of those tariffs and the high freight costs they incurred when this inventory was sourced back in late 2024 and early 2025.
Oh, so they're sitting on product that was more expensive for them to acquire in the first place.
Exactly, but they're struggling to sell it at full price. So this forces them to cut the selling price even more aggressively, potentially even below their already inflated cost just to clear the stock. This just accelerates margin damage into fiscal 2026, and it confirms that the glut is both large and extremely costly.
So finally, let's talk about the defense mechanism. The $1 billion buyback authorization. This is meant to signal confidence, but you see this with some forensic caution. You called the buyback illusion.
It's the classic corporate playbook when your stock is falling, try to shrink the share count to engineer some EPS growth. But you have to look beneath the surface. You have to adjust the benefit of that buyback for the company's stock-based compensation expense, SBC.
For our listeners, what is SBC and why does it dilute the buyback?
So stock-based compensation is when the company issues new stock to its executives and employees as part of their pay. And Lululemon's trailing 12-month SBC expense is substantial. It's roughly $206 million.
So a big chunk of that billion-dollar buyback isn't actually shrinking the shares outstanding or returning capital to shareholders.
It's just offsetting the dilution that's caused by the ongoing issuance of stock to the management team.
So it looks good on paper, but it's like using half your money just to pay for a leaky faucet.
That is a perfect analogy. And furthermore, buying back stock when your operating income is falling 11% year over year is just a risky move. If the underlying profitability, the E in PE, continues to shrink, the stock can actually become more expensive even as the share price falls.
And we've seen this movie before.
Oh, history is littered with examples. Once dominant retailers like Gap or, tragically Bed Bath & Beyond, who bought back billions in stock while ignoring the fundamental erosion of their business and ultimately just destroyed capital and shareholder value. Lululemon is at risk of falling into that same exact trap.
So the structural financial problems, they all flowed directly from a failure in product identity and a loss of their competitive position. Lululemon is now fighting a war on two fronts, being squeezed by both the high-end rivals and the low-end commoditizers.
At the same time, their once insurmountable moat, which was based on technical quality and brand loyalty, it's been breached from both the top and the bottom.
So detail that first front for us. The high-end siege. The alloification of the market. Who is gaining share here and what are they doing differently?
Alo Yoga and Worry are the two primary threats. They have successfully established themselves as the next evolution of premium athleisure, and they're particularly capturing that crucial Gen Z and younger millennial demographic.
And Lululemon's original position was?
It was rooted in technical performance and community. Local ambassadors, yoga studios, that kind of thing.
And the new guys?
They rely on aspiration. Alo is an expert at leveraging really aggressive celebrity and influencer marketing. They position their product as high-fashion streetwear. Their stores are these aspirational, minimalist concepts, almost like luxury sanctuaries.
And that makes Lululemon feel?
It makes Lululemon, the longtime leader, suddenly feel corporate, safe, or even, and this is the damning one, a mom brand.
Ouch.
And if you lose that cutting-edge perception, the $98 price tag starts to feel unwarranted. Alo and Vori are gaining market share by appealing to the consumer who wants to feel exclusive and fashion-forward, not just comfortable in a studio.
And that cultural shift is incredibly difficult to fight, especially when it's happening at the same time as the second front, the low-end siege, the dupe economy.
And this is the commoditization threat. The Align legging, which was Lululemon's greatest intellectual property, their biggest cash cow, it's become widely replicable.
It's everywhere now.
The market is flooded with dupes. From Amazon's private labels, from TikTok Shop, from competitors like Aerie. And these competitors are offering 90% of the stretch, the softness, the aesthetic performance for 25% of the price.
And in a high inflation environment where consumer wallets are squeezed, that value proposition is just impossible to ignore.
It is. Why would you pay $98 when you can get a functionally similar product for $25? The dupe economy just destroys Lululemon's pricing power from the bottom up. Once the consumer realizes the technical difference is negligible for daily wear, the premium justification for Lululemon's price just dissolves, and it leaves them exposed to this relentless race to the bottom on cost.
And this external pressure is just compounded by the internal product void, which was perfectly captured by CEO McDonald's own damning admission.
We have become too predictable.
Too predictable. What was the consequence of over-indexing on those soft trends you mentioned?
Well, the problem was leaning too heavily into these easy-to-replicate categories. Things like Softstream or the Scuba hoodie, they're basically just comfortable loungewear. Lululemon's original genius was technical fabric, innovation, patented, proprietary materials that were really hard to copy.
And when they shifted focus?
They lowered the barriers to entry, they actively invited the competition and the commoditization that we're seeing today. They stopped innovating in their protected zone.
And the breeze-through failure is the clearest operational proof point that the innovation engine just completely stalled.
It demonstrated that the company's internal quality control just broke down. Rushing a product to market to meet some internal newness target, only to have it fail because of fit and quality complaints, is a complete violation of their brand covenant.
And the embarrassing mass returns.
It not only lost revenue, but it also broadcast to the consumer that Lululemon's commitment to quality was being compromised by its relentless pursuit of growth.
And you connect this quality breakdown directly to the numbers using what you call qualitative forensics. What are the actual customers saying?
We look at platforms like Trustpilot, and the data in late 2025 shows a deeply disturbing trend. There is a surge in negative reviews, and they're all dominated by specific, recurring complaints about declining quality.
Like what?
Pilling fabrics on expensive leggings after a few washes, unraveling seams on premium jackets. Our interpretation is that the company likely initiated these aggressive value engineering efforts to protect its margins against the rising costs of tariffs and inflation.
Meaning they substituted cheaper materials or chose cheaper manufacturing to save a few dollars here and there?
Precisely. They were banking on their brand loyalty to cover the difference. But that minus 5% comp sales contraction confirms the consumer noticed, and they voted with their wallet. And once a premium brand loses trust in its fundamental quality, which is the only thing justifying the premium price or gaining that trust, is an extremely costly and multi-year proposition. This is not a quick fix.
Okay, let's look forward. Where does Lululemon even go from here? We have to start with the company's now highly questionable strategic targets. The Power of 3x2 plan, which targeted $12.5 billion in revenue by 2026. Is that even mathematically plausible anymore?
No. It is mathematically implausible, and it needs to be abandoned. The current FY 2025 guidance projects revenues around $11 billion. To hit that $12.5 billion target in the single year after that, 2026, they would need nearly 14% global growth.
And what does that mean when we split the business again between the U.S. and international?
Well, if the Americas segment stabilizes but stays flat or even shrinks a little at minus 2%, the entire 14% global target would mean the international segment, China and EMEA, would need to grow at an unsustainable 40 to 45% rate.
And that's not going to happen.
That pace of sustained growth is almost unheard of for a business of Lululemon's size, especially with all the geopolitical tensions we talked about.
So we should fully expect the new CEO, Maestrini, to formally rebase these expectations.
Absolutely. This process, it's often called kitchen sinking in corporate turnarounds. It involves resetting analyst expectations to a much lower, more achievable level. And this will likely trigger a final round of downward revisions and capitulation among the remaining long-term holders who were still clinging to that power of three dream. The market needs realism now, not impossible goals.
Which brings us to the core valuation question. Lululemon currently trades at a forward PE of around 12.5 to 14.5 times. Now, given its history of trading at 30 or 40 times earnings, that low multiple might scream bargain to a traditional value investor.
And this is the moment for the forensic verdict. This is the value trap.
Explain that.
The market is typically pretty efficient, and that 12 times multiple is not a deep discount. It is, in fact, appropriate, and you could even argue it's generous, for a mature retailer that now faces shrinking domestic earnings, a permanent structural 290 basis point hit to its gross margin, and significant governance instability.
So the stock is just priced for its new diminished reality as a mature, cyclical apparel company.
Precisely. The market has correctly re-rated LULU from a hypergrowth stock to a distressed turnaround story. There is no easy multiple expansion available here. For the stock to regain its former premium, they would need to credibly reignite North American comparable sales growth back into the high single digits,
Which requires fixing the product pipeline.
a minimum 12 to 18-month strategic initiative.
So if we look at a discounted cash flow, a DCF reality check, where does the current price of around $187 to $190 per share sit in terms of risk?
That price is priced perfectly for what we'd call a muddle-through scenario. Meaning the Americas stabilizes and international growth slows down a little but stays healthy. However, it lacks a sufficient margin of safety. If that America's contraction accelerates, or if the China growth story hits a significant, sudden geopolitical speed bump, the implied downside is substantial. And without a margin of safety, what looks cheap can become much, much cheaper.
So what does this all mean for the listener? To synthesize this entire forensic autopsy into, actionable knowledge, let's summarize the 3 core takeaways.
Okay. First, the product identity crisis and fixing the stale assortment. That is going to take 12 to 18 months minimum, which means the negative comparable sales in the Americas are likely to persist deep into 2026. This requires patience, which the market rarely grants.
Okay. Second takeaway.
Second, that tariff hit is structural, and it is permanent. The 290 basis point gross margin contraction is here to stay. That means Lululemon's historical profitability profile is permanently impaired unless they can find some new proprietary innovation that justifies another round of price increases.
And the third and final takeaway.
And finally, that inventory build, the 11% growth versus 7% sales growth, and that higher cost basis. It is a ticking time bomb. It guarantees continued, aggressive markdown intensity, which will exert further, sustained pressure on margins through at least the first 2 quarters of fiscal 2026.
So a textbook example of systemic failure.
Driven by execution gaps and a changing regulatory and competitive landscape.
Yes. So Lululemon is fundamentally no longer that growth compounder that was immune to market cycles. It is now a mature, cyclical retailer fighting for relevance in the very market it created, but no longer seems to control.
And the challenge for the new CEO is not just immense. It requires skills he has not yet demonstrated in this kind of turnaround scenario.
Which leads us to the final provocative thought we want to leave you with.
Right. Lululemon is now structurally dependent on international sales, particularly China, to sustain even moderate overall growth rates. And history shows us repeatedly that markets assign significantly lower valuation multiples to earnings that come from politically sensitive regions.
Because of the geopolitical and volatility risks.
Exactly. The stock has already fallen from its peak 30 times multiple down to 12.
So the ultimate question for you, the well-informed listener, is this. How much further should the stock's valuation multiple compress, even if the China story remains successful? Should this company be viewed through a retail lens or a complex multinational risk lens that warrants an even steeper discount? That is the structural complexity the new leadership must navigate.
And speaking of monitoring the overall temperature of the market and recognizing systemic risk, we invite you to track total market temperature by searching for and downloading the iOS app Buffett Indicator from the Apple App Store. You can receive daily updates on the Buffett Indicator, which can help you gauge market bubble conditions.
And remember the disclaimer. All the analysis here is based on publicly available sources and is for educational purposes only. It does not constitute investment advice. You should always conduct your own due diligence before making any investment decisions. And if you want to listen to our full deep dive about this topic or access more advanced content, welcome to join our Deep Value Club membership or subscribe to us on Apple and Spotify podcasts channel, Deep Value Investing.
We look forward to connecting with you on the next deep dive.